Today we have Sriker from Critical Value Asset Management, and we'll be discussing Jazz Pharmaceuticals, ticker JAZZ. This is a healthcare biotech company. I do not own shares of it as it's outside of my circle of competence or outside of my lane. But it was very interesting talking with Sriker about it just because we use a very similar investment process, a similar kind of checklist with, even though it's a completely different industry, we kind of go through look for a variant view and deep research. So that's kind of how we connected on this. I found the research and the value proposition very intriguing with the cash yield and the potential catalysts. For me, I wouldn't be able to validate or invalidate some of the work that he's done. And if there's something that goes wrong or right, I wouldn't know when to sell. I wouldn't know when to double down. That's taking someone's advice to begin with is okay, but then you don't know what to do when there's a problem. And that's really the reason I'm not going to go here, even though I was very intrigued by the value proposition here. So with that, I'll turn it over and let Sriker give you a quick intro about himself, his firm, and then we could get into the 10-step variant view.
Thanks, Doug. So I'm Sriker Nadipuram from Critical Value Asset Management. It's a fund that my chief investment officer and we launched in 2023, started deploying capital in October of 2023. We're focused exclusively on healthcare, with the vast majority of our time being spent in the biopharma space globally. Prior to this, my chief investment officer and I were both at AllianceBernstein in the ARIA platform. We were market neutral investors there. Right now, at Critical Value, we are directional investors. We're not quite market neutral, though we're not 100% long or something like that. We're still a hedged and a portfolio that tries to provide biopharma exposure to investors with relatively low volatility compared to some of our peers. Prior to AllianceBernstein, just my personal background, I was on the sell side for about 5 years, covering US biopharma at UBS and Barclays. And prior to joining the sell side, I'm a pharmacist by training. I got my doctorate in pharmacy and spent about 4.5 years at a large academic medical center in New Jersey, focused on mostly pediatrics and PT/Onc. So I really appreciate the opportunity to be on this, Doug. Thanks.
No, thanks for taking the time, and thanks for educating me about the healthcare space. And it's always amazing how many extra years of training all my friends in asset management have to do in healthcare. They always get PhDs in real world experience, another 5-10 years of expertise, and then they end up choosing finance. And it's just the bar is even higher in terms of the expertise for the field.
It helps one, at least knowing the vocabulary going in. Science is changing so much, so everyone's expertise, we constantly have to relearn and learn new things. But I know the vocabulary, I know the machinations of at least getting a drug from molecule to the patient's bedside.
Great. So could you just give us a quick overview of Jazz in terms of the stock price, the market cap, and then what has drawn you? Why is this stock interesting to you here?
Doug, you touched on it. Why I wanted to talk about a stock like Jazz to a more generalist audience. What's unique about Jazz in the biopharma space is that it has a relatively stable base business in a therapeutic area that they have a dominant position. And then they have a pipeline that's getting very interesting and has a really key catalyst that we'll talk about. So just going into it, Jazz is at about $110 per share today. Market cap of $7 billion, EV of about $9.9 billion. And its average daily traded volume is 140 million. So a pretty liquid stock that people can get in and out of. They're in two distinct therapeutic areas. One is narcolepsy and neurology as a whole. The other is oncology. So their neurology business is considered their base business. They have two large assets that have multi-billion-dollar revenues currently. One is in narcolepsy. Narcolepsy is a sleep disorder where people just basically fall asleep randomly and don't sleep well at night. And so they have a key drug called Xywav. Xywav is interesting because it's an older drug, and it's actually a derivative of the date rape drug. And so we know it puts people to sleep, and so it's been their largest asset for several years now, and is undergoing a little bit of a transition that we can touch on later as well.
Before we get started and kind of get into the background of the company, I always like to start with understanding where people are coming from. Are you able to disclose, does your fund own this stock? Is that something you're able to disclose? And if so, what kind of weighting do you put behind it?
Yeah, right now, at this very moment, we do not own the stock, and we're trying to figure out in terms of an entry and kind of bob and weave in terms of this macro environment.
Is there something on the macro environment? I think when we had spoke, maybe a month or two ago, I think you did own it then. What has changed in the macro environment, or is it just something else you like more that doesn't have as much political risk?
Yeah, well, right now we're trying to figure out, along with probably a ton of other investors, the tariff situation. We're expecting tariffs to be on specific pharmaceutical tariffs to be announced sometime either this week or next week, and so we want to see where the whole market shapes up after that announcement. And Jazz is a Irish domiciled company, so negotiations between U.S. and the EU matter. Tariffs do matter for one of their large drugs. It doesn't matter for their narcolepsy drug. It matters more for their seizure drug that they have. And so these are all things that we're just trying to get a little bit more clarity on. And for us, the key catalyst is the clinical catalyst that's coming up in the second half. So we have a little bit of time to kind of digest the macro and then find an entry.
And how much risk did you associate with the macro and the potential tariffs and the unknown if the worst case scenario happens and it's not just, having a talking a big game and everything comes to fruition in the worst case? How much risk is there to the stock?
Yeah, so I mean, again, when I flex our model, decrease margins, I get to about in the mid to high 90s. So not that much more risk that can get on a reasonable valuation on a multiples basis. Right now, next year in my base case, I can get to about $21 per share. In a very stringent scenario. Again, it's only one of their assets that should be impacted by tariffs coming from outside of the United States. So I get to somewhere in the high teens on their
You're talking earnings per share there, right?
earnings per share. Yeah.
Okay. So you're saying worst case on the tariff, the impact to the stock price, it's at 110, it could go 95 or 95-ish. If the tariff thing blows over and it's just posturing, where's the upside if the clinical trial happens?
The upside I get to is around $180 to $190 per share. This clinical trial, it unlocks, Jazz has been talking about a $2 billion peak sales opportunity on a $4 billion revenue base is a significant move up on a very high margin oncology drug product that they already have sales infrastructure in place. And so the incremental dollar is very high margin. It's basically, gross margin plus.
So your overall risk reward here seems like you're kind of on the sidelines. There could be $15 of risk just based on however the tariffs play out versus a fundamental clinical new asset that you can layer on top. That would be 70 to 80 of upside. So pretty good risk reward, it seems.
Yeah. No, I think so as well. I mean, this drug completely will change the prospect of this company from a neurology focused company, and it'll shift it to an oncology focused company. And especially the bigger distinction is it goes from a company that's viewed as not innovative, using an old drug like like sodium oxybate, like the date rape drug, is just not viewed as innovative and exciting for biopharma investors. To go into something that is very innovative, this zanidatamab, and we'll get into it's called a bispecific antibody, which is a relatively new technology.
So let's go to kind of the second question is, do I understand this business? And you started to talk about, let's try to understand as simply as possible the current $4 billion base business and what is that comprised of and what are kind of the key puts and takes there?
Yeah. So their biggest drug is this drug called Xywav. And it's as I said before, the generic name is sodium oxybate. It's a reformulation of the date rape drug, and is meant to treat narcolepsy. Right now, sales for this is around $1.5 billion. They just recently, within the last couple of years, have transitioned from a older formulation, which was a drug that patient had to take 2 times at night, and that had a really, really high sodium level, almost 9 grams of sodium in the old formulation, to one that contains no sodium. And so it's viewed as safer for patients with narcolepsy, because you're just giving them less sodium. Remember, like just for like reference, generally you don't want more than 2 grams of sodium in a day, just from dietary sodium. And we kind of know that sodium for people with high blood pressure and stuff like that, people that are overweight, just isn't good for them. So, and people with narcolepsy and sleep disorders tend to have other comorbidities, tend to be of higher weight, tend to be obese, tend to be may have hypertension, like high blood pressure as well. And so eliminating that sodium content from the drug actually does make a difference. And so they've been able to transition basically 80% of their business to this different formulation already, which, in addition to being safer and healthier for the patient, extended their patent life. And there is a generic out for the older formulation. And so they're competing with that older formulation. With that said, they still have 80% of the market. And so that's their key business. As the years go on, I do expect it to erode. 2033 is kind of where the cliff comes for this drug, when I expect other generics to enter the market. And in a drug like this, you do expect relatively fast erosion. And so like I model in 20 to 60% erosion in the out years for this drug.
Now, what about the barriers to entry on this drug due to safety protocols and distribution, given the unintended consequences of it being similar to a date rape drug?
Yeah, no, that's a good question. So this is controlled by, in addition, regulated by the FDA. It's also regulated by the DEA. And so there are quotas that are put out by the DEA that only X amount of drug per year can be manufactured, and every year the DEA has to approve those quotas. And so it's an extra layer of regulatory work that a generic company has to go through. The other thing a generic company has to do is create this thing called a REMS program. A REMS program is just basically a way to track every individual patient that's on the drug. And so this isn't that simple for a generic company. Generic companies don't generally have the infrastructure to do this sort of thing. Generic companies are manufacturers at heart, and manufacturers and distributors. Most don't have the infrastructure to do this. So even with the patents going off, I don't model that severe cliff that other small molecules tend to go through, and other small molecules can erode 80% in the first year. Here I model a slightly more gradual erosion of 20 to 40%, 60% kind of in the out years, as generic companies continue to take share. And even with that, price compression will be less, since the margins on this will be lower. The generic companies do have a higher cost to to enter the market, so they can't cut completely.
And where is this drug actually manufactured?
This is manufactured in the United States.
What about the rest of the base business? What are the other key components of that kind of 4 billion of revenue?
Yeah, so the other big product is in their base business on their neurology side is a drug called Epidiolex. Epidiolex is a drug that's approved and on the market, and it's used for rare seizures. This drug is also a derivative. It's a derivative of marijuana, and so it uses THC. The one of the important aspects of this is that it's mostly manufactured ex-US in the UK. And so here's where the tariffs and the tax implications could expose Jazz to some earnings compression. Importantly, again, with barriers to entry, Jazz actually has a large growing facility in the UK, and this specific strain of THC is extracted from the plant, and it provides another kind of barrier to entry because it makes it harder for generic companies to copy the drug. This isn't chemically synthesized. This is grown. So this is another $1 billion franchise for them, and again, relatively durable because of the barriers to entry. Which I want to emphasize that point, that their base business is relatively durable versus other pharma and biotech companies because of these. It's hard to manufacture and these regulatory barriers that they have. So that's about 2.5 to almost 2.7 billion of their base business. The rest is oncology, and it's a newer aspect of this company. They have multiple smaller products that are in more rare and niche cancers. Their newest drug approval is this drug called Ziihera. The generic name is zanidatamab, and that's the clinical catalyst. That drug has the clinical catalyst that we'll talk about in a different cancer. And again, why I think that it's more de-risked than other clinical catalysts, because the drug is already on the market for a slightly different indication in cancer.
And we'll get into this later, but how big could that drug be? What could that do to the earnings power of the company? How would it change if this was approved?
Yeah, no, I think this drug, so they're looking at this drug in multiple different cancers. One, it's approved for biliary tract cancer, which is a smaller indication, which has peak sales of about $200 million, which is how I model it. It's the next clinical catalyst is in this cancer called gastric cancer. Here, I think this is a bigger indication. There's about 5 times as many patients in this indication, and not only that, duration of therapy is longer. So in cancer, unfortunately, most people die of the cancer. And all of these drugs are out that we have right now, almost none are curative. But what they do is extend life. And the longer they extend life, the longer the patients are on the drug. This is a drug that's about $7,500 per month per patient. And so every additional month of life is significant. It's great for the patient, but also significant revenue for Jazz. So I think the gastric cancer indication could be, about 5 times larger than the biliary tract cancer, so about $1 billion indication. And then we're not getting data for a little while, but it's also going into breast cancer. And breast cancer is just a much, much larger indication. There's different types of breast cancer that it'll go after, and we'll get more data clarity, and that's more towards the latter end of the year, next year type of stuff on that. But Jazz has said $2 billion is a reasonable for peak sales for that, and I think that's very achievable. And we'll underestimate their sales if they're able to hit on these clinical catalysts.
So that's called a 4 billion going to 6 billion potential in terms of top line revenue. The current unlevered free cash flow we were discussing is about 1.5 billion with about 350 of interest expense right now. Is that right?
That's right. Yeah.
How would that change if this is successful? What would the company look like?
Look, I mean, I think in the early 2030s, as zanidatamab ramps and before Xywav goes away, they can get to free cash flow of around $2 billion. The reason why it doesn't just layer on and double, there's going to be increased SG&A, there's going to be increased R&D expense. I also have uh, conservative how I model it. I model because there's generics and entering for Xyrem, the previous generation for Xywav, the high sodium version. I model some erosion. Some insurance companies will just require patients to take the cheaper generic version, even though it is an inferior product. And that's just the bottom line of how our system works. There's also possible competition from other mechanisms of action. And I think working in some erosion and some competition for those is prudent and reasonable. So I can get well above $2 billion if the narcolepsy revenues kind of stay flat. But I don't model it that way. I model about 5% erosion in the medium term.
If the person is higher risk and has other issues with hypertension, they can't have a lot of salt. Will the insurance company cover the lower salt version, or do they have to get an exception? The doctor writes a note, or they're just like, sorry, we're going to make your condition worse.
Yeah, I mean, like that's the short answer is that it depends on the insurance company. The long answer is usually what ends up happening is the physician will have to do something called a prior authorization, and the patient's physician will speak to the insurance company and talk with them and justify why a patient needs to be on this lower sodium version. And usually for the most part, Jazz has said that there hasn't been like that many rejections or anything like that. But it is an extra administrative burden. We also don't know, if as there's more generics that come out for Xyrem, it's possible that insurance companies just say, try this and check the patient's blood pressure more often.
More administrative work, more trips to Quest, but lower fees, I guess. So overall, is the stock available today at a reasonable price?
On a fundamental basis, I mean, the DCF I can get to well above $200 on a multiples basis. Historically, this company kind of on a PE multiple basis, historically is traded around 9 times. On a $21 EPS for 2026, that easily gets me to around $180. I think this is very, very cheap right now, and cheap for not the right reasons.
How much of that value that you're ascribing is due to the base business, and how much of that value is due to the drugs that are in progress?
From my model, if I zero out any pipeline value and erode the business, I still don't get on a DCF basis. I still don't get as low as where the stock is trading right now. And so I think right now you're paying for the base business, and you have limited downside on this clinical catalyst that's coming.
Perhaps it's like a free option, it sounds like, and it seems like even you guys, it's people are on the sidelines because they just don't know what's going to happen. The uncertainty around Europe and tariffs. It's like, I don't care if I'm buying it higher. Let's just wait till the uncertainty is behind us and chase it up.
Yeah, and I think like that's kind of played out in the last few months. Being in front of a clinical catalyst hasn't really paid that well for the most part. It's taken a few hours to days for the market to figure out, well, like, whoa, this is like good data, like let me get into it. And then on the same token, when you have unequivocally bad data, companies have just gotten crushed, because I can get to a fundamental valuation, but that doesn't mean there are buyers at that fundamental valuation. And so like the stock price is very different from what the stock valuation should be. There are plenty of biotech companies right now that are trading well below their cash on hand. And I think the last count I saw was something like 200 out of the 700 publicly traded biotech companies are trading at cash or below.
Are those companies that are burning cash and that they're just assuming they're not going to have a good return on that cash, I assume?
Yeah, I mean, those are companies that are burning cash, basically have no base business like Jazz does. There's no floor. There's no fundamental floor because they're just the only option that these companies do have is to do the R&D. And so they're trading below their cash. Jazz again is rare in this business where it has a relatively stable base business, has a very competent management team, has in therapeutic areas that are of demand, that have like significant clinical need, and have shown good data for their clinical catalysts that we can get into.
So when a lot of times stocks will trade up into an event and then they become sell the news, right? There's no incremental buyers. The fast money said my catalyst is gone. No reason to be there after, even if it creates a certainty around a certain cash flow in the future. Have you seen stocks trade up into events and then no matter what happens, I got my catalyst is gone. I have to sell it like a sell the news event. So, you might want to, will it even trade up into it where you have to exit before the event sort of thing, or you won't even get that alpha curve into an event?
In general, these stocks do trade up into events as people start to do work on it. As the biotech and biopharma specialists start to do work on it, they see that there's a dislocation between the probability of success that the market is ascribing to what the data should actually be. And as that gap closes, the risk reward completely changes. And so it turns into, you ride, if you're in it early enough, you can ride the run up. And then as the risk reward changes, you reevaluate whether you want to be there or not for the clinical catalyst. Could it happen with this? I think it could happen with this one. I mean, this is, again, it screens really cheap. And for the generalist investor, there is a quantifiable floor. It isn't zero. They do have sales and revenue and real earnings. This is a profitable company with significant free cash flow. And so I think once people realize that and then start to do the work on this clinical catalyst, they'll see that it's a little bit more de-risked than the typical oncology, phase 3 trial.
And so our fourth question is, why is this stock mispriced? We've kind of danced around this, but if you had to say it in a sentence.
I think it's gotten lumped in with all of other biopharma on the macro side. The correlation with the XBI is fairly high in the last few weeks. And so I think it's just gotten lumped in, wrongly so, where this is different from your typical biopharma, biotech company, where it does have a floor to valuation, while also having a very interesting and more de-risked clinical catalyst than I think the market appreciates.
Yeah, when we were talking, last time, you kind of put this in a bucket of specialty pharma and biopharma kind of together. And so the fifth question is, what is your variant view versus the street? And yeah, I mean, there's a lot of other very smart people out there who probably know there's a trial coming up on this drug. What is your view? How is it different than other kind of smart healthcare folks?
Well, I think like a lot of people do realize that this is more de-risked than others. The one thing, just from going back to a macro thing, the generalist money in biopharma has kind of exited. And so part of that is the biopharma investors as a group just really aren't big enough to completely move things and make things completely efficient, I think. And so more capital needs to come in. And so that's one aspect of it, why it's mispriced and where my variant view is. I think my variant view is definitely much different from the even generalist healthcare investor that spends a lot more time trafficking in the, United Health and Tenet Healthcare, those hospitals and health insurance companies.
Well, this is a 10 billion EV company. It is still pretty large. It's in indexes. I'm sure other folks have to have this on their radar as well. So why are the generalists and the long onlys out of the sector currently? Is it political uncertainty? Just drug pricing? They're just why are they out of it right now?
Yeah, I mean, I think it's two things. It is the political uncertainty on tariffs, and it's again tariffs. I'm going to lump tariffs and tax kind of in a similar bucket. Most of these companies pay a very, very low tax rate. Uh, if you remember in 2014, 2015, 2016, inversions were really the thing where Pfizer wanted to buy an Irish domiciled company in order to get the Irish tax rate. And this was before Trump came in and lowered the tax rate from 35 to 21 before TCJA. But back then, Ireland was, I think it was a 9% tax rate. And now it's a little bit higher. But that uncertainty, that tariffs and tax rate has caused one thing. So in models, you see these companies with low double-digit tax rates into perpetuity, and so that's a difficult thing to reconcile in a generalist head where it just doesn't. It could change significantly, and so I want to avoid that risk.
What is their current tax rate that Jazz pays?
It's like in the low double digits right now. Like 14%. Yeah.
That could double in theory, if not more, and that you have to.
Well, again, like I'm not an economist, so in theory, it could go up. It could go, higher. Conservatively, the way I model, I try to put in 20% as the tail for tax rate, and so it'll be some sort of increase. I expect a tax rate to increase, and so I think it's reasonable to assume a tax rate increase. The other big elephant in the room is drug pricing. We constantly have tweets from President Trump. We have huge public outcry on how expensive these drugs are. You mentioned specialty pharma. The business model of specialty pharma, when it first started, was literally taking old drugs, tweaking it slightly, and jacking the price up enormous amounts. So enter Jazz Pharmaceuticals, where they took the date rape drug, they tweaked the formulation to make it safer, and they did, and then now it's $100,000 a year drug. People don't view that as innovative. It's something that people don't want to really invest in if they're biotech investors. And that's why I got lumped in with the Teva and Mylan and if you remember Valiant back in the day, it kind of got all lumped into that group, and we called it specialty pharma. When I think now they over the last 5 years they've been exiting that and shifting their business to a more innovative business, providing tremendous value to patients while also pricing drugs at a healthy premium. And so Trump and all the political noise that's happening with drug pricing, it makes sense if I were a generalist investor to not touch this, because it's within the realm of possibilities for the U.S. government to say that, hey, we're going to pay what Austria pays, or we're going to pay what Poland pays. And so that's the fear, that's the debate, and that'll definitely be a negative for the entire industry, and we'll see what the ripple effects are, where companies might not launch drugs in other geographies. Companies might try to jack prices up everywhere. It just provides a lot of uncertainty for the generalist investor to avoid the sector as a whole. And then on your side, if people can make a ton of money on the, Mag 7, and, understand that business because they're living it and they're playing with it every day, it's a lot more tangible. You talked about the training that healthcare investors have to go through. I think it's been a real detriment and real negative to the biopharma investing industry that it's gotten so complicated. And the stories are just harder to tell, and which is why I want to bring it back to Jazz, where it boils down to, for a generalist investor, stable base business. You have a really interesting pipeline asset that could increase revenues in the near term by 30 to 50%, and that's the thesis that it boils down to.
And you talk about the Mag 7. You're looking at a 3-4%, unlevered free cash yield. Here, this company is north of 15, and if this drug hits, it could go to 25. You don't exactly need the duration and the terminal value, but it is helpful to understand that the pricing is an uncertainty, the tax rate. Like, there are definitely some pressures in the business. The question is, at a north of 15% unlevered free cash yield, are you getting credit for that risk? So it's interesting. So let's go into what is your evidence? How did you go about researching this? What tools did you use to kind of come up with all this knowledge about the incoming drugs, the current drugs, the market share? How do you find doctors and everything?
Yeah. Okay. I mean, I use a lot of market research tools and stuff like that. I go through transcripts on AlphaSense a ton. I have to go through every single thing where these companies present, see how they change their language, and a tool like AlphaSense actually helps with that, because I can follow how they change their language on certain topics very quickly, which is important because there's a lot of nuance to how management teams speak, similar to any other industry. Picking up tone and different words on clinical trial progress matters a lot, and so I look at that. The other thing too is science constantly changes, so I have to look for experts and speak with experts. I have a background, I know the vocabulary, but I didn't invent the drug or know that, so I have to go through each of the different phases of the clinical trial, and I speak with experts. I find them through expert networks like Tegas, and go through transcripts. AlphaSense has a lot of transcripts too, that I on experts that I like to go through and look at. It's just an essential part of my process where first I try to identify what the questions are, what the thesis is, and then you have to find people that can help, and Tegas has helped with that.
Okay, great. So it sounds like you use the library, but you also have AlphaSense folks go out there and find experts for you as well. Did I hear that right?
Yeah. I use both. I think it's really important the library is actually really important because I do want to see what experts are telling other people. And I do want to know what other people are asking the experts. And so that provides a lot of insight to me. And then my, individual one-on-one conversations with experts allows me to hone in on a specific issue that I have, a specific question that I have that maybe wasn't answered in my previous research, or wasn't answered by management.
Great. So let's move on to the next question, number 7. What are the catalysts for the street to realize your view?
The big one is the data that's coming in the second half. That data readout will tell us definitively whether or not this drug works in gastric cancer or not, and that'll open up that about it could be $1 billion opportunity for them in GEA, in gastric cancer.
Before, you mentioned 2 billion. There's more to gastric, and the other cancers is what's included to make it 2?
Yeah, so 2 billion actually is for the entire franchise. So right now it's approved in biliary tract cancer, and so it's out on the market for that. The clinical trials in specifically for gastric cancer, kind of cancer of like the stomach and the esophagus. And then they have more clinical trials that'll read out later on in breast cancer and other cancers. And so there's that each trial unlocks a certain segment of revenue.
And when are you supposed to hear about the trial results? How certain is that? Can it get pushed?
Yeah, that's a good question because it did get pushed already. Jazz pushed the trial back, the disclosure back from first half, from later in the first half to the second half. And the reason these trials get pushed back is because the primary endpoint of the trial is to measure something called progression-free survival. And that's how long a patient can stay on the drug without the tumors getting larger. And so what needs to end up happening is that you need a certain number of events to happen, meaning a certain number of patients on the drug and on placebo or on the control arm just need to have growth in their tumors for the trial to read out. And so it's not something that has a definitive time point. So you don't really know exactly when all of these patients or some of these patients are going to have growth in their tumors. And so that's why it got pushed back per management.
And you also talked about this drug already being approved for certain applications. How does that play into you waiting? I mean, the whole process is what's the prize and then what's your probability of getting it, right? So how do you discount the probability for this drug in particular?
Given that this drug is already on the market for another indication, it significantly de-risks the next indication. One, we have like clear evidence that this drug kills cancer. It's in a different location, but we have clear evidence that it does it. So that removes some of the uncertainty around efficacy, some of it. We also have clear evidence of the safety. There's always two aspects of drug approval. There's efficacy and safety. We know the safety profile of this, and more importantly, the FDA knows the safety profile of it, and they've already approved it and allowed it to go onto the market. So there shouldn't be the probability of having a red flag pop up is lower than a typical drug where it hasn't gone through the regulatory rigor of the FDA. And so a typical phase 3 drug trial, the probability of success is generally 50 to 80%. If I put it in that bucket, 50% on the lower end are drugs like drugs for depression, stuff like that. That's more of a coin flip. 80% is more very targeted drugs for rare diseases that we know the exact mechanism, and this targets that specifically. And so here in an oncology trial, and in general, I'd say is in the middle-ish of that range, so like 60 to 70%. But that includes uncertainty around safety and efficacy. Here we have more safety, more certainty around safety. We also have more certainty around efficacy, not only because it's approved, but also because of the very, very strong earlier stage data that we have in gastric cancer.
How long has the cousin drug been on the market for safety monitoring?
Yeah, and I wouldn't even call it the cousin drug. It is the exact same drug. It's the exact same drug. And so it's been on the market for a little over a year now, I think. I think it's about a year. A year or so. Yeah. But not only that is we have clinical trial experience with it as well. And also the FDA has approved it. Like the important part is the FDA has approved it and has gone through the safety from the other indication. And so that gives us some comfort where, because the FDA is privy to more information than we are, they get everything. We only get what's presented in public. The other thing I want to talk about is the earlier stage data in about 45 patients that came out fairly recently at a oncology conference called the ASCO Drug Conference. And there the data that this drug showed in gastric cancer is about double. It extended life about 2 times as long as the current standard of care. Um, Again, smaller trials, 45, 46 patients, and this trial is 900 patients. But smaller trial, uh, single arm, it didn't have a control arm, but the initial data is very, very promising. And even if that data gets worse in a larger trial, there's a lot of room for it to get worse.
If there's a good readout, what's next? What's the next step?
Yeah, the next step for this drug is them, speaking with regulators and then submitting the application within hopefully a few months. Before that, it's possible that the community, these gastric cancer communities, it's relatively small. There's about 65,000 patients a year in the US, and EU and Japan. So not a ton of patients, and more importantly, not a ton of specialists and key opinion leaders. And so news of this data should be spread fairly rapidly. And Jazz, it's possible before official approval, some use could happen, but less probable. We're looking at approval, at least a year from now, like FDA approval, if not more.
You know the size of the market. How do you know the revenue, the price essentially that they might be able to charge?
Yeah, so I mean, the way I do it is we know the price for biliary tract cancer. It's about $7,500. The list price is about $7,500 a month. Um, Here we have to make some assumptions on because the way I model it on revenue per patient. So you make some assumptions around the duration of therapy. Uh, the data that they're currently showing right now, it's not unreasonable to assume a duration of therapy of 12 months. It could be longer. The earlier stage study showed progression-free survival of about 15 months. So assuming 12 months is reasonable, that's $90,000 plus on a list price basis per patient per year. You take some rebates and some haircut for compliance. It's not unreasonable to have this at these $75,000 per patient per year. Um, and so that's where I start with.
Who are the rebates? Who are those for? How do those get in there?
So everyone kind of takes has their hand in the cookie jar in order to get it on payer formularies and things like that, on hospital formularies. Uh, in order to get it to distributors, uh, you need to give them a rebate, kind of like a volume rebate, and that's par for the course for this industry. Um, it's kind of just the toll that you have to pay, and so there's every middle intermediary takes a little bit of share. For example, like in oncology, a 10% ish rebate is is reasonable. Is kind of what we assume. Sometimes it gets as high as 20% in a super competitive market. But if you go to something like GLP-1s, like Lilly and Novo have, the rebates they're giving are probably 50, 60, 70% to those middlemen in order to get preferred places on formularies. So oncology, because these drugs are immediately life-saving, the middlemen kind of know that they can't really take that much. You can't really steer a physician and a patient to a certain drug because we don't, for the most part, we don't have head-to-head data. And so you have to leave it up to the physician. For GLP-1s, you can say that we prefer Lilly because they give us a higher rebate. It's not gonna kill a patient right away.
Do they put them on a healthy diet before they give them a drug, or they just go right to the drug? And
And I mean, insurance companies actually do require 6 months of what they call lifestyle modifications, and you have to give evidence of lifestyle modifications. Uh, so
that's good. No, that's good. All right. Now, question number 8. What is the company worth if my bet is right?
yeah, I mean, I think this can easily get up to $180. We talked about a revenue, like unlocking a revenue door for at least $1 billion just for this indication, if not de-risking the breast cancer indication to get up to that $2 billion peak. And then, adding that on, we talked about free cash flow, the earnings power is significant for a drug like this. As we said, the drug is already approved for a different indication, which means that Jazz has the commercial infrastructure, the medical affairs department already built, the sales reps there. They will have to increase sales reps, just to market to a slightly broader physician base. But they have all the infrastructure in place, and the incremental dollar for Ziihera, the zanidatamab, is basically a cost plus. So you're removing costs. These drugs are the cost of goods sold for these drugs are very, very low. I mean, it's somewhere between 5 and 10% of the sales. So it's very profitable.
Question number 9 is, what is the other side of the bet? If you're wrong, there's always another side.
Yeah, I mean the bear case. It's always possible. It's a clinical trial, so there's always things that could happen. And, a safety issue could happen. Efficacy might not just be there in this patient population. The control arm, it's possible, could do better than expected, better than historical control arms have done in this indication. But with that said, the reason why I'm kind of pitching this to generalist investors is that this does have a base. It does have a whole neurology area of their business that's relatively stable. It does have other oncology assets that are smaller, that are a couple $100 million in revenue now, that are growing. They're not going to be billion-dollar products, but they are still growing. And so this isn't a company that's bare. The other thing too is that we talk about free cash flow. These companies don't return cash to investors, and so that free cash flow is a little bit of a it's a little bit in the ether. But what they can do with that free cash flow is redeploy it and be acquisitive. In this environment, we talk like all biotech companies have kind of gotten hurt because of the macro environment, but that's good for acquirers. There's a lot of good science out there. There's a lot of good drugs out there that if this does fail, they could look externally to deploy capital that they have.
So it seems like you've got an idiosyncratic catalyst with this new drug that's somewhat de-risked by it already being in the market for another use. And you have the risk of potential tax rate going up, prices on existing drugs under scrutiny. Can you hedge that out with other stocks so that you're just isolating this, potential catalyst of the new drug?
Yeah, I think so. So, I mean, that's where when we look at baskets of stocks, we definitely look at how each stock correlates with, our index, the XBI that we look at. We look at it, how it correlates with other individual stocks. And that could definitely be just extracted out. Part of that is we do some clinical catalysts can bring the whole industry up as a whole. This is not one of them, but that's something to be aware of, that it's possible that other things could move in the same direction. There is a pure play on this catalyst if you do want to do something like that, and it's a smaller biotech company called Zymeworks. That's ticker ZYME. They have a royalty on this drug, and they'll move significantly on this. I haven't done the work on the valuation work on that, exactly how much they'll move, but if you do want a pure play on this, that's one of them. The other issue is that it has no base, and so.
Well, so that's the pure play, pure risk one. It seems like Jazz is kind of the middle ground where you have the base, and you're not getting necessarily credit perhaps for the potential value uplift, but then is there a way to hedge further erosion in the base from tax and drug price? Would you just hedge the XBI against it to Would that work?
That's one way, yeah, on a dollar basis, or on a correlate on dollar beta basis, you could do that. Um, it's we try to be a little bit more selective, than doing something like that. There isn't a single stock that I think correlates perfectly with something like this on the macro side. You do have this does have different macro implications than a typical biotech company because it is Irish domiciled, and some of the IP is out there. So that's that. But there are, I think, we would put together a basket of stocks that kind of looks at that and hedges that risk a little bit better. Again, if necessary, the catalyst is coming. We're expecting it in the second half. It's hopefully we get some clarity on this macro environment within the next few weeks.
What do you say, clarity? That's just on the tariff situation. You still have drug pricing and you still have tax rate.
Yep. That's going to be there. Yeah.
And then the last question here is management aligned with ownership? And I guess, why don't we do capital return? How come activists don't get in and say, do a buyback, give us the money back? And
It's getting a little bit more common now that there's so many biotech companies that are trading under cash, that the exuberance of COVID and post-COVID, there was a huge influx of cash into biotech and biopharma, and that kind of caused, uh, a bubble basically where bad science, I don't want to say bad science, but science that was way too early to come to the public markets came to the public markets. Management teams that were better served as being, chief medical officers and scientists became public company CEOs, which is a totally different skill set than being a researcher and a clinical trialist. Um, and so there are activists that are trying to agitate these companies to just shut down and return cash to shareholders. Jazz, I think, is in a different class because it has a real business. It sells drugs. It's proven that it can do this. I think that the business model for these biopharma companies is they feel that, rightly or wrongly so, they feel that the incremental dollar that they invest in R&D is worth much more than either dividending out or doing a share buyback. What we've seen is most of the time that's wrong. Uh, it's just the nature. But the issue is that the payback is so asymmetric that these management teams are willing to do that, and investors historically have been willing to go on that journey with them because it's possible that a $10 billion company goes to $100 billion company in a relatively short amount of time. We saw that with Moderna during COVID times, when that went from a relatively small company up to the largest biotech company in the world, or one of the largest biotech companies in the world. And so that asymmetric payout is what people invest in the biotech and biopharma world for. With that said, I don't think that environment holds right now. And again, going back to Jazz has a relatively stable base business with the floor. This is not going to go to a $100 billion company. This should go to be a $15 billion, $16 billion company as currently constituted. And so that's where I think that, we can speak to investors that aren't as well versed in the healthcare and the biotech world, where quantifiable downside and then the upside is still very significant, though it is not a 2, 3, 4, 5x.
yeah, great. It's it seems like a very compelling risk reward, and I've learned a lot about the industry. And thank you for making it so understandable to the non-expert, and I'm gonna keep it on my radar. So thank you for your time. Any closing words?
No, I just really appreciate the time, Doug, and I hope generalists can see Jazz is not the only company like this. There are other companies with with good businesses within the biopharma industry that I think require that should have more attention on them from a lot of other investors, and hopefully we'll get more capital in.
All right. Well, thank you. Thanks for your time.
Thanks, Doug.
Please make sure to follow Pitch to PM on your favorite podcast app and never miss out on episodes. This show is for entertainment purposes only. Please consult a professional before making any decisions. This show is copyrighted by Pitch to PM. Written permission must be granted before rebroadcasting.